Good evening and a warm welcome to Quest Means Business. Once again, US stocks are falling as investors nervously watch the moves in the bond markets. Higher bond yields make stocks look relatively less attractive as an investment, and that's what's going on right now. The US 10-year Treasury yield hit its highest level in a year, 1.5%. It's even topped the S&P 500's dividend yield at one point today. The Nasdaq has seen massive growth throughout the pandemic, far outpacing the broader market. This week, however, it's falling back to earth. As you can see, down this session some 2.7%. Alison Kosick is with us. Just talk us through today's price action. And Alison, great to have you with us.
Great to see you, Julia. So there was something that happened earlier today that kind of spooked equities investors. They saw that 10-year Treasury yield spike 0.2% to over 1.6%. And then, as you said, it did settle back down, but it's making investors really, really nervous. And they've had their eye on these rising bond yields, but now they're getting especially nervous. The thing is, if you look historically, these yields are historically low, but we're seeing sort of a different landscape now. Now we're seeing more of a recovery in the economy, and we're seeing movement in the bond market. And the concern is, of course, that rising yields can make a load of corporate debt that companies are carrying. It can make it more expensive. That could eat into corporate profits. It could also hurt the housing market, which, as you know, Julia, has been booming since the pandemic started. And the concern is that could eat into the economic recovery. And this, despite what we saw from Fed Chair Jay Powell talk about on Capitol Hill, him sort of, sidestepping inflation, any kind of inflationary pressures, saying he's going to go ahead and keep rates near zero, continue on with the $120 billion bond buying activity that's going on per month. But it looks like, investors aren't willing to really listen to that today. It seems like these worries that have been building for a long time meaning for a few weeks, those worries seem to be winning out today, Julia.
Yeah, that's the conundrum, isn't it? It's being driven by economic recovery, but at what point does it actually start to be a problem for that economic recovery when it drives up things like mortgage rates? Great to have you with us, Alison, and great context. So, as Alison was saying, these moves are being driven by rising bond yields, but the rotation within stock markets is also key. Investors starting to move out of some of the pandemic winners and into those that will benefit from economic recovery. If you remember when the lockdowns first started, companies like Zoom and Peloton enjoyed huge growth, and tech stocks have gone through a historic run over the last year, from the giants right down to the small caps. But now we're seeing things like entertainment benefit, think movie theaters and theme parks, and airlines, of course, hoping that once vaccines get into play here, we'll see passengers jump back in seats and we'll see a resurgence in tourism. Now, while hotel chains hope to welcome back all those eager travelers and see their vacation spending. Right, JP Morgan Chief Global Strategist David Kelly joins us now. David, great to have you with us. Just talk us through, in your mind, what we're seeing in markets.
Well, what we're seeing is the market has figured out that this economy is going to absolutely boom later on this year. The numbers in the pandemic are getting better. They're getting a lot better. The vaccinations are being rolled out. And so by the summer, I think things will begin to get back to normal. The pandemic will recede. In the fourth quarter, we're going to see a boatload of spending. And then you add on all this fiscal stimulus, the economy should be really humming. And if it's doing that, that pushes up long-term interest rates. It pushes up the thought of inflation, but it also pushes up real interest rates. That's what's going on with the Treasury market. And I think all other markets are taking their cue from that basic reflationary trade, the idea the economy is going to do much better going forward.
I mean, that's the irony, isn't it? It's a positive thing, but at some point it's becoming, or at least investors are suggesting, it could become a challenge more broadly for stocks at the same time. Is the perception here perhaps that the Federal Reserve is losing control to some degree? I mean, Jay Powell came out this week and said, look, don't worry about inflation. We're going to be as stimulative as ever because we care more about jobs. But investors seem to be saying, at some point, you're going to have to talk about the recovery, and you're going to have to acknowledge that perhaps inflation risks are a problem.
Yes, I think that's right. I mean, I think there's the Federal Reserve, for example, if you look at their forecast, they think that at the end of this year, the U.S. economy will have grown by about 4.2% year over year. Now, we think it'll be a lot stronger than that based on our models. We think unemployment will be below 5%. So I think the Federal Reserve is very very dovish. It's trying to keep rates low, but I think people do understand that the economy might do better. And by the way, I don't think the stock market's getting hurt by the idea that higher rates will slow the economy. The real problem is that if you have a stock which is selling at 25 times earnings, what it really means is that stock is valued on decades and decades of earnings into the future. And when long-term interest rates go up, all those future earnings are worth less now. And it's really that discount rate that's actually hurting those high PE stocks.
It's a relative play, isn't it, as well? For so long, we've not seen any real return from bond markets as well. And stocks looked so attractive, but they are a riskier asset relative to bonds. And if you start to see bond yields go up, suddenly it's like, OK, well, there is some return being offered by bonds.
Well, some, but to be honest, I think that long-term rates have got a lot further to go. So I think that that's a tough trade also. What it is helping, though, is value stocks, the stocks which trade at lower PEs, things like financials, energy companies, industrial companies, who will really benefit from this cyclical rebound and aren't as sensitive to long-term interest rates, or sometimes in the case of financials, actually helped by higher long-term interest rates. So that's why I think you're seeing this rotation going on in the market towards those value stocks because of higher interest rates.
I want to talk to our viewers as well about GameStop. Its shares surging once again after doubling in price late Wednesday. There are several theories about what's driving the rally. One claim that this tweet of a soft-serve ice cream cone could be the trigger. It was posted by Ryan Cohen, a GameStop investor and incoming board member. He's pushing for change at the company. David, I'm not going to ask you what your take is on them ice cream cones and what signals perhaps that sends to the market. But how is all this playing in, do you think, in terms of what we're seeing to the broader structure of markets?
Well, I think it should send a message to the Federal Reserve that there's some price to have for having easy liquidity and very low interest rates forever, because it is fueling some bubbles in different areas. I think for long-term investors, you've got to realize, look, you've got your Vegas money and you've got your long-term investment money. And your long-term investment money should not be put into things that do not make fundamental sense, because what goes up ridiculously fast can come down ridiculously fast too. So I think people should make sure they understand what they're buying, understand that it does make sense in the long run. And a lot of these bets just don't.
Yeah, but the Fed's willing to put up with frothiness in markets and concerns about inflation in order to try and bring back what the 10 million jobs that were still down since the pandemic started. What's the outlook here? Because as you've said, bond yields are still on a relative basis historically low. A lot of this is just being driven by the hopes of recovery here too. What's the outlook for stocks? David, what's your message to investors?
Well, I think that stock prices are pretty high, particularly in a rising rate environment. I do think that we'll see those 10 million jobs come back pretty fast, because a lot of them are in the service sectors, which have been hit by this pandemic. When the pandemic ends, a lot of these people are going to have to get hard back fast to staff our hotels and our restaurants and our entertainment and all of these things. But for stocks, it is, U.S. stocks are a little bit more expensive. Growth stocks certainly are expensive. So I think people should look at international stocks, look at value stocks, but particularly look at valuations everywhere. Just buy stuff that makes sense in the long run based on valuations. Because, as we get out of this pandemic environment, as things get clearer, I think those valuations will be more important.
Yeah, makes perfect sense to me. David Kelly, great to have you with us. Thank you so much for that.